After so much volatility last year, it is refreshing to report positive numbers for Q1. As I've addressed in previous webinars, 2022 was a very rare year where both stocks and bonds were down double digits. But recall that in Q4 of last year, it actually ended with stocks and bonds both higher. This rally occurred as inflation peaked, and then investors began pricing in easier monetary policy, feeling that the possibility of recession was still far enough distant in the future. In the first quarter, those same themes continued to dominate markets, and we again have positive returns for both stocks and bonds, stringing together 2 consecutive quarters. In March, we saw a very large and very real crack in the banking system that resulted in 2 banks being taken into receivership. A government backstop facility was also put into place to prevent contagion. However, along with inflation and the path of interest rates, investors will be looking for the continued fallout from the March bank crisis. Some questions to consider are, will similar weak banks need to be shut down? Will credit remain very tight and choke off growth? And what will the impact be on corporate earnings? And finally, will there be pressure on sensitive asset classes like commercial real estate? Turning to market performance, the S&P 500 was up 7.5% on the quarter. And looking at the details of the US stock market, there was a wide variance. Roughly 15 stocks accounted for nearly all the gains in the S&P 500. And you can see the mega cap index we track was up over 29%. The biggest winners were Nvidia at 81% and Meta at 68%. Small caps, seen in the Russell 2000, were up just under 3%. So again, a wide disparity versus large caps. The most logical explanation is that the larger tech and consumer discretionary stocks rallied as investors rotated out of financials after the March crisis, with the bank indexes down just under 20%. With the yield curve shifting lower, the mega cap stocks benefited as they're more sensitive to rates. I will also note that the tech industry has very publicly cut their labor force and many of the fancy benefits they once flaunted. This shift in focus to profitability also helps explain their strong quarter. Note that since the current bear market low of 2022, the S&P 500 has bounced back 14.7%. But valuations have also crept up, as illustrated in this next slide. You can see that the S&P, with the price to earnings at 17.8, we are above the 25-year average of 16.8. International equities were positive on the quarter, with the MSCI Equity Index up 8.5%, higher than the S&P 500, despite having more exposure to financials and less to technology. Emerging market stocks at one point were up 12% in January because of China's reopening, and eventually closed the quarter up around 4%. Similar to equities broadly, international and EM stocks sold off during the March bank crisis, but bounced back a bit near the end of the quarter as both contagion and recession fears have eased. Both international and emerging markets remain attractive given cheaper valuations than the US, which you can see on this slide. The chart on the left shows that historically, they are a full 2 standard deviations cheaper compared to US stocks based on price to earning ratios. The chart on the right shows that dividends are also higher for international stocks. Meanwhile, the dollar was about flat in the first quarter. But remember, it is roughly 10% lower than at peak levels witnessed in the fall of last year. A flat to weaker dollar will be supportive of international stocks. Lastly, on this topic, this slide is a slide we've shown in previous webinars from JP Morgan, focusing on the length of outperformance from US to international stocks. This slide shows that outperformance historically has occurred in cycles of varying length. Currently, we are in year 14 of the cycle, which is the longest seen in 50 years. You can also see that this outperformance accelerated in the past 3 years, which can be attributed in part to the amount of stimulus that the US put in relative to the rest of the world. So, cheaper valuations, a flat to weaker dollar, and the length of the current cycle provide some reasons to remain optimistic about international and emerging market stocks. As I mentioned in the org update, Dave shared even more reflections with international opportunities in a recent blog, which you should check out. Now, on to fixed income. The bond index has posted their second consecutive quarter of positive returns, with a 3.3% gain in the international aggregate and a 3% gain in the US aggregate. The only negative on this chart is commodities, which were lower by 5.3%, but are moving higher in April. The OPEC production cut is pushing oil prices and commodities broadly higher. Let's conclude with a look at the movement in the yield curve. The green line is June 2022, early into the rate hiking cycle with an upward sloping yield curve. The blue line is the start to 2023, and the orange line was the end of Q1. You can see it in the first 3 months that the yield curve has shifted lower from 1 year out as investors are starting to price in a slower economy. The yield curve has also become more inverted as the Fed continues to hike rates. One of the conundrums in the market today is that the bond and stock markets are pricing in very different things. While the inverted yield curve signals recession, stocks have rallied and are either ignoring or pricing in those risks. Another conundrum is that the Fed continues to signal there will be no rate hikes in 2023, but the market is pricing in 3 to 4 rate cuts by the end of 2023. Let me close with a few thoughts. After last year's volatile and sharply lower markets, we now have another quarter of gains. As we've noted in previous webinars, it's rare to have 2 consecutive years of negative returns. Markets have now shrugged off the banking crisis, but we will continue to watch for another round of pressure and the impact on both the credit markets and earnings. Economic focus is shifting from inflation to both economic and earnings growth, which we will continue to watch closely. It's unlikely that the next decade will look like the previous decade, as leadership, particularly in stock sectors and frequently in countries, has always rotated. Wespath builds globally balanced and diversified portfolios that seek to allow investors to take advantage of the next market leaders and avoid the highs and lows of being overly concentrated. We continue to believe that investors should stay the course, remain invested, and focus on long-term results.